Good afternoon, everyone, and welcome to today's Professional Advisor Working Lunch, brought to you courtesy of our partner, Baillie Gifford. I'm Katrina Lloyd, Editor-in-Chief of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through our usual housekeeping. I should inform you this session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session today. Around half of the world's population resides in Asia. Many Asian companies are deeply embedded in structural trends that are globally significant. Yet Asia ex-Japan equities take up less than 10% in the global equity index. There's a strong chance that having sufficient exposure to Asia becomes one of the most important investment decisions many of us make for the next decade and beyond. Despite increasing macro resilience and the emergence of world-class companies in the region, Asian equities are still offered at appealing valuations compared to their global peers. Well, that's the view of our guest speaker today, and she'll be addressing this over the next 40 minutes or so. I'm delighted to be joined by Qian Zhang, who is an investment specialist director on the Baillie Gifford Emerging Markets client team. As their Pacific Fund marks its 35th anniversary this year, Qian will discuss why that length of tenure matters in a fast-evolving market like Asia, and why Baillie Gifford believes today is definitely one of the optimistic starting points for the asset class. Now, we really want the session today to be as interactive as possible. I think we already have a question that's come through, but please do leave your questions for us in the chat function, which you will find at the bottom of your screen. So just before we start the session today, let me quickly run you through our learning objectives. So by the end of this session, delegates will have understood the underappreciated macro resilience of Asia today, learned about the world-class Asian companies and the growth trajectory ahead of them, and explored the secular and cyclical opportunities in Asia. So that's the CPD covered. So let's hear from Baillie Gifford. Qian, good afternoon, and I'm handing over to you.
Thank you very much. Good afternoon, everyone. Thank you for joining us for this session on the Baillie Gifford Pacific Fund. As just mentioned, this year is the fund's 35 years anniversary. Out of the more than 150 managers in this universe, only a dozen have done this for so long. So hopefully that offers us some credit in talking about investments in Asia. Now, when I was preparing for this session, I thought I first asked ChatGPT about the investment case for Asia, and here is a short answer. Asia posed a compelling investment case. Asia's economic potential, increasing middle class, advancement in technology, and low correlations with global markets makes it an attractive destination for investors who are seeking for diversification and potential high returns. I thought that was a not too bad answer. But joking aside, the fact is that despite the world's economic gravity has shifted towards Asia, the investment gravity has actually lagged. Despite accounting for more than 60% of the global growth, Asia only takes less than 10% in global indices. We think having enough and proper exposure to Asia is one of the most important investment decisions that many of us will make in the next decade. So in this short presentation, we would like to share our views on why now and how we could approach Asia smartly. We're going to structure this as a country tour, so covering all the major markets in Asia, and then in the end, we come back to the fund and the portfolio itself. So let's start with where is the hottest at the moment? India. So one of our team members returned from a research trip to India, commenting that he has never been on an investment trip where everybody was so unconditionally positive about the future. There are, however, structural reasons to be optimistic as a stock picker for India. The country is at an inflection point where the progress in infrastructure has opened up a series of new possibilities. It took 45 years between 1970 and 2014 for India to build 5,000 kilometers of railway. And between 2014 and 2020, only 6 years, the country added another 2,500 kilometers. India has also leapfrogged from a country with the poorest mobile internet coverage to one of the best and cheapest in the last few years due to the vast 5G rollout by a company called Reliance Jio. With villages more connected by trains and then consumers more connected by data, many new business models that couldn't have existed before becomes very promising. Digital financial services, e-commerce, logistics to support e-commerce, all provide fantastic opportunities at a company level, and the hunting ground looks rich for the future. India in the past 2 years have seen more unicorns, which means private companies with valuations more than $1 billion, than the whole previous decade combined. To name but one example, the fund invests in a company called Delivery, which is Delhi Delivery. It's a leading logistic operator for e-commerce business. Now, despite operating in an industry where the barrier is quite high and scale is very difficult to build, its addressable market is immense and is set to grow for many years to come. China now delivers 130 billion pesos a year, and India delivers 4 billion pesos a year. The top-down picture is still quite positive for India. For many years, private sector capex in India has lagged. That means the economic growth hasn't met its potential as people expected. But this has finally started to change. Last year, Air India said it would buy 470 planes from Airbus and Boeing. That is the biggest ever order from a single airline. Fintech lending has surged to almost 300 billion in 2022 in India, up from less than 10 billion a decade earlier. So the question is, can the party continue? As expectations were quite high, there is a rising risk that actual growth may disappoint, and valuations look stretched, particularly in small and mid-caps area. We are very aware of this, and actually our focus has been more on the large cap companies with moderate valuation, and we're overweighting the relatively undervalued part of India and being very selective on earlier stage, fast-growing digital companies. Saying that, we continue to see Indian market continue to be a good source of new ideas in the future. Now let's move from data to molecules. Indonesia mines more nickel than the next 3 biggest producing nations put together. Rich nickel resources have made the country a key link in the battery supply chain. It has also been very clever with policy. Indonesia's flagship industrial policy, called downstreaming, has banned some of the raw material export, and as a result, attracted billions of investment from foreign battery and EV companies to process materials within the country. Its local industrial parks are bigger than the size of Edinburgh, where our headquarters of Baillie Gifford is based. These policies help Indonesia to get more value out of its natural wealth, support a healthy economic growth, and its young, vibrant population. The middle class is growing. We invested in a small subset of companies in Indonesia, mainly by banks. Now let's move from molecules to what we call picks and shovels. During the quiet period between Christmas and New Year last year, I used what we call Sidekick, which is our internal AI assistant, to help to summarize a number of global market outlook pieces for 2024 from the banks. And within a few seconds, it gave me outlined common topics, Federal Reserve, inflation, and Chinese GDP. But are these really the right areas to focus for stock pickers? And the most rewarding stocks over a 5 years plus horizon seldom had much to do with these macro factors. Even last year, it would have been the promise of AI, and I don't remember seeing these mentioned in many of the 2023 outlooks. I guess my point here is when looking at the real world changes, technological shifts have far more significant impact on the big winners' growth than macroeconomic factors. And that is good news for Asian investors. A garden ant is about 3 to 5 millimeters, and that is 3 to 5 million nanometers. The most advanced chip produced by Taiwan TSMC is based on 2 nanometers technology. What does 2 nanometers mean? You could fit 1 million of these units over one single ant. The picks and shuffles in the semiconductors industry requires many years of R&D and generations of expertise to master, and definitely a strong edge we look for in identifying great growth companies. Many of these picks and shuffles companies are found in Asia. Either it's microchips produced at scale by Taiwan's TSMC, world-leading memory technology through Korean's Samsung Electronics or SK Hynix, or niche data center switches by Taiwan's Acton Technology, and specialized etching machines by Korean's EO Techniques. The advancement of AI and many other modern technologies simply aren't possible with these Asian companies. Now let's move to China. China is the largest country in the Asia ex-Japan index, but its weight has come down from a peak at 45% to less than 30% today. China does face multiple macro challenges, which the market has to navigate through in recent years. That's regulation, the economy, and geopolitics. It's true that the Chinese economy is going through a transition where the new growth drivers need to replace the old. It's likely that the new growth drivers such as green energy, digital economy, automation, and consumption evolutions, etc., wouldn't be as powerful as the previous real estate supercycle. Therefore, the aggregate growth rate will slow further. However, the new growth drivers are mostly long-term structural trends happening on a sheer-size economy, which dense resources of infrastructure, talents, and capital within the country. These continue to create what we call micro blooms at the company level, despite the macro doom. Pinduoduo's shopping app Temu has entered almost 60 countries within a year. Luckin Coffee is growing to 3 sizes of Starbucks in China. 10 years ago, China doesn't have much semiconductor manufacturing capability. Now China takes 30% of the global material node production. Domestic chip producers are increasingly taking market share. My point here is there are still actual growth at a micro level that could be captured by active selection. Our Chinese holdings in the portfolio looks very different from those in the index. There's a very selective barbell approach. At one side is on molecules, the energy and materials that enables China's economic transition. On the other side is on data, which is soft technologies with fast-growing internet and AI companies, plus hard technology, i.e. domestic semiconductor producers who help China to achieve its goal of self-sufficiency. The good news here for Asian investors is that China is no longer the only game in town. Our largest country overweight is off-index allocation to Vietnam. We think this might be the best structural growth story for the next decades within emerging markets. The strategy first invested there around 8 years ago, at which point it was quite hard to access, liquidity was poor, foreign ownership limits was restrictive, and we could really only manage through a third-party fund. However, the attractions were clear. Vietnam's export base has grown significantly over the last decade plus. It has perhaps the best structural setup among ASEAN countries to build a manufacturing-led economy. It has a young and very low-cost labor force, very good schools, more friendly policies for foreign direct investment, and is also geographically well positioned, giving it very easy access to Chinese input from production. Vietnam started with apparel making that has turned into a boom in the more skilled consumer electronics sector. It is clearly beneficiary from global supply chain repositioning, and we are patient and optimistic long-term holders there. So as we finish the country tour, I'd like to come back to a few comments at the asset class level. Asia is a rapidly growing region. Asia's investment landscape often undergoes significant shifts. In the early 1990s, China barely registered as an investment opportunity. Today, about a quarter of Fortune 500 companies are in China. The types of companies that come up with the growth heading also change. From Hong Kong financials in the 1990s to Thailand shipping companies in the 2000s, and Chinese e-commerce platforms in the 2010s, and Korean and Taiwan semiconductor makers in the 2020s. This marks the importance of a pragmatic approach to growth in Asia, a key lesson we've learned over our 35 years journey in managing dedicated Asian strategy. We want to look at growth in all forms and to capture evolving opportunities and to capture them early. We're deliberately targeting diverse type of growth, so our holdings can have various potential routes to achieve the goal of long-term capital returns. There are 3 types of market inefficiencies that we focus on. Number 1 is companies that can grow over a longer term period than expected. Think about endurance or duration, companies with very deep competitive moats that can continually reinvest in themselves, spending counter-cyclically on CapEx and R&D. The key thing here is not to look at quarterly earnings from time to time and try to time in and out in the stock market, but try to be directionally right and let the growth coupon compound. Take HDFC in India, for example. This is India's largest private sector bank and the leading residential mortgage provider. As Indians get wealthier, moving to the cities and buying more homes, the private sector banks are also gradually taking market share from their incompetent state-owned peers and consistently in a growing market. HDFC looks to compound its own loan book at 15% per year and a very steady multiple. The strategy has invested in HDFC since 2008. This highlights the importance of letting the holding compound. We believe this holding power, backed by thorough research, can be a very effective way of generating decent long-term returns. The second bucket are companies that are growing at a faster pace than expected. So these sell-side estimates normally forecast Asian company to grow somewhere between 0 to 20%. But in reality, more than 15% of the companies grow at more than 40% per annum, but less than half of the estimates capture that. Analysts always fall down at the extremes, and if we dare to imagine about what might go very right, not just go wrong, then these high growth stocks can be a very strong source of long-term returns. Delivery, as I mentioned, is a good example here. The third bucket, we call it growth surprise. These are simply companies growing when no growth is expected. Even if we haven't had growth in a certain industry recently, if we can identify an inflection point or a cyclical opportunity as external conditions change, then this can lead to very strong returns as well. One example here is our investment in copper mining industry. These are not perhaps your traditional growth type of companies, but we do expect them to deliver. Copper demand normally grows with GDP rate, and we believe the extra demand will come from green transition. We'll add on top of to that. And in addition, also a new leg of demand may well boosted under the rest of AI, the electricity grid upgrade, data centers, etc. All of these need copper. While it's hard to forecast copper prices in the short term, the investment case really comes from the supply side, which is extremely tight. It takes more than 10 years at least to build a copper mine. And when looking at the global capex in the mining sector in the past decade, there's no way the next decade they could meet the potential demand growth. Although short-term copper price is volatile, the long-term supply-demand gap is very visible. Now, by balancing longer growth, faster growth, and better growth, we think we have a portfolio that is stronger, especially compared with the backward-looking index. Our pragmatic approach to growth means a portfolio that is often very different from the index or other peers. Rather than being driven by a single theme, the portfolio is supported by a diverse range of secular, cyclical, and idiosyncratic growth drivers. This ranges from off-index allocation in the structural growth story of countries like Vietnam to attractively valued Chinese platform companies to top semiconductor suppliers in Korea and Taiwan to digital fintech names in India and key energy and material producers that are in the region and indispensable to power Asia's own growth and the global green transition. We think we are at an inflection point today where the Federal Reserve started to cut rates and the US dollar may start to trend down as the US deficit stays high. A weaker dollar could be a significant tailwind for Asia and the emerging market more broadly. Moreover, the recent Chinese stimulus announcement appeared to mark a rhetoric change from the top, and it's likely that more pro-growth policies will support domestic sentiment towards Chinese equities, which has been extremely pessimistic in recent years. Now, despite the external challenge in recent years, namely the higher US rates and stronger dollar, rising geopolitical tensions, conflicts in Europe and Middle East, and recently, during the summer, the dramatic unwinding of yen carry trade has caused a lot of market volatilities. But when you look at Asia, Asian economies have not only avoided crisis, but most have prospered, outpacing growth in many Western countries. A number of Asian democratic countries have also seen very smooth transitions of political power and continuous orthodox policies. Asian markets have also demonstrated resilience as well. Now, from a macro perspective, we perhaps cannot ask a better backdrop than this for growth in Asia. And more encouragingly, from a more bottom-up perspective, we are discovering an increasing number of good growth companies, particularly ones with substantial growth potential, while valuations remain attractive. Asian market is still trading at discount to developed market, but the fund itself, although outgrowing its index from a forward-looking growth perspective, as you see on the page, is still trading roughly the same valuation level versus the index when you look at the price to earning ratio. So growth is really on offer. Today is certainly an optimistic starting point for Asia. And that summarizes our session. Happy to take questions.
Hello, thank you. Thank you so much for that. Really, really interesting to hear going through all the countries and those growth drivers there. Thank you so much for that. And we apologize. I think there was a little technical difficulty with a couple of the slides in the middle of that. Hopefully the commentary was enough to get you through that, but we will be supplying the slides with the recording as well afterwards. So you'll be able to look at those as well. So yeah, let's start with some questions. And I do encourage you as well to please put your questions in the chat function as well, and we'll try and answer as many as we can. Yeah, so first question, we've got a question here. Is the Chinese stock market pulling out of its nadir, or are there more downside risks to equity prices? It's one of the big questions for investors in this region, isn't it, at the moment? I know you mentioned that in the presentation, but maybe you can sort of go into a little more there about some of those risks potentially.
Yeah, sure. It's a quite important one and on top of a lot of investors' mind. Our view on China is constructive from the short to medium term, but longer term trajectory is still unclear. The reason behind that is China has been caught in a perfect storm in the past several years from a macro perspective, whether you look at the economic recovery since the pandemic has been very weak. There is a property downturn in general, which is structural, and also domestic regulations has been unpredictable for a couple of years as well, and also growing geopolitical tension. As a result, many good growth Chinese companies, despite delivering quite strong operational progress, are trading with very depressed multiple, a very depressed valuation. And that potentially opens opportunity for stock pickers, especially when you look at Chinese internet companies, for example. The regulations have clearly moved from a rectification case to a more supportive phase, with the official announcement from the regulators of finishing the fine for Alibaba and more supportive tone to the develop of softwares and AIs, etc. That also is consistent with what we hear from the founders of the companies, of these big platform companies that we invest in. And collectively, most of them all tell us from their own conversations with the regulators, the big platform companies are increasingly being recognized as a very essential part of the Chinese innovation system, where the top-down policymakers are very keen to build as a tech superpower for the country. So that aside, there are a number of things, positive things aligned for investing in Chinese market, but for us, stock selection is still the key, because longer term, the geopolitical direction and how Chinese economic would transition still remains unclear. But short to medium term, we think is a good market for stock selection. And also the recent announcement of new series of stimulus, although we still need to wait for the more details of the physical stimulus, but that coordination nature of a number of new supportive policies did mark a tone change from top down, that China is back to support growth. So that a number of positive aligned, short to medium term, very constructive for stock picking. Longer term remains relatively cautious from a portfolio construction perspective.
Yes, and I suppose those stimulus measures, as you say, there's that tone change, but now we're waiting for those further details. Some commentators saying, maybe wanting them to see going further than this. I mean, it's quite interesting to see how that will work out, I suppose, in the sort of months and even years ahead with what they're doing. But as you said, it's interesting you use that phrase, that tone change there. Do you think that has been quite significant, that they feel they need to do more at this point to really get the economy going again?
Yeah, so the announcement of the monetary policies so far and additional special bonds, etc., the absolute amount of that altogether isn't as impressive as the 2008 and 2009 era. However, the tone change is a significant one, because in Chinese system, coordination in policies do matter, because that means the KPIs for the local regulators and local government might have changed from a quite cautious risk-averse tone from the pandemic years, like you can't really make mistakes, you need to implement very stringent top-down policies, you need to control risk about investment in property sectors, etc., to more a pro-growth tone. If you make genuine mistakes because you want to stimulate your local economy, that's fine. So this kind of tone change in top-down policy and potentially a shift in the KPIs at the local level does matter for a big bureaucratic top-down governance system like China. So saying that, we might need more details for the fiscal stimulus to gauge how much that I can turn from the economic perspective. But it might not take that much to turn the market sentiment perspective because sentiment has been extremely low. One of the very encouraging signs from recent announcement is the central bank PBOC has formed a special loan pool as like a central fund to lend very cheaply to listed companies in China to encourage them to buy back their shares directly. So that is very direct liquidity injection to the domestic market. And then let's not forget, majority of the domestic market or Chinese equities are owned by domestic investors right now, and their sentiment do matter. And saying that, I want to come back and making one more point about thinking about Chinese economy. I think it's fair to say China's economy isn't collapsing and it isn't booming either. It is slowing down and it is in transition. And for stock pickers, only focusing on the aggregate level of growth may miss a very important part of the overall picture. The part is that maybe the property sector is slowing down and that creates a drag in overall growth. But the new growth drivers such as green transition, digital economy, industrial upgrading, etc., are increasingly filling the gap, and they are in very strong policy tailwinds. And at a company level, a change at this scale create opportunities. If you can ride the tailwind for that, it can create a lot of growth opportunities at a company level. So there, back to my point, there's still actual growth at the company level in China that can be captured by active selection, where focusing only on aggregate growth levels may miss this important points.
Yes, it's interesting as well, I suppose, investor sentiment over here towards China. We have seen, as you said, that sort of extreme pessimism and quite a discussion around the investability of China. We've seen some funds launch, for example, that have taken China out and are looking at other regions. But as you said, it's also that smart investing side of looking for those real, pinpointing those opportunities.
Yeah, that's right.
Like frozen a little bit there. Yeah, sorry.
Yeah, that's right. Like we do see there is some discussions on looking at China separately, taking China out from global or EM allocations, etc. But there are drivers behind that can be quite complex. So financial returns is one, but also political, geopolitical, and reputation risks can be another one. Some of our clients said like China only takes a very small portion of our overall allocation, but takes like 80% of our brain power. It is true that investing in China is increasingly more complex compared with 3-5 years before. So it is still merit the risk of investing in that very complex country. I think the point here is whether investing directly in China or not, understanding China and understanding Chinese economies and companies are increasingly more important than 5-10 years before. Because when you look at the global competitive space, China is a very important market for a lot of global companies, including EM companies, including like Asian companies like Taiwan, Korea, and even Southeast Asia. And also increasingly as a global competitors in terms of manufacturing to a lot of developed market economies as well. We can't underestimate how China is important as a market to a lot of companies, and can't underestimate how competitive a lot of Chinese companies has become at the global space. People talk a lot about deglobalization, but what really happens isn't deglobalization, it's a decoupling between US and China. And then when you look at the intra-trade among Asian countries, it has been steadily growing and growing to a historical high as almost as 60%. So emerging market countries and Asian countries, there are a lot of them in the middle who doesn't need to pick a side and who can increasingly benefit and leverage of trading more with both sides of the divide of the geopolitical tensions. So when you think about that, I'll give you one example of Chinese car export. China has become the biggest car exporter in the world, and 70% of the China's cars are exporting to emerging countries, not developed countries. Listed Chinese companies are now selling more to global south, i.e. emerging countries, than global north. So that is exactly the blind spot that we as stock pickers shouldn't ignore, whether directly investing in China or not understanding Chinese companies is crucially important for global stock pickers. But saying that, as I mentioned, China is no longer the only game in town.
Yeah.
We increasingly see increasing numbers of investment-worthy companies and even world-leading companies from emerging market from Asia as a good diversifier, and very excited to invest in the long-term growth in the region, in and outside China both.
Yeah, so really, really interesting observations there. I suppose leading on to that, I wanted to ask you a little bit about, obviously we have the US election coming up in a few weeks. Very, very tight. We're not sure, of the result yet, but obviously a lot of questions there about what could happen and relations with China and Asian countries, depending on who wins that. Maybe you could get your sort of views on that. I'm sure it's something clients have been mentioning to you on your visits with them as well.
Yeah. So I think that the short answer would be we probably, it's not something we want to speculate on, especially when you have like a largely 50-50 poll at the time. And some people say while a Democratic wing will perhaps lead more predictive US policy towards China, but a Trump wing could potentially counterintuitively result in some sort of potential surprise, given Trump is historically like making a deal and relatively flexible from an ideological perspective. However, I think the point here in our mind is, regardless of who will be in the White House next year, he or she may look to spend more in one way or another. That means a large or even widening US deficit will continue, and that will continue to put downward pressure on the dollar, which is a tailwind for Asia and EM more broadly. The US-China decoupling trend is largely independent from the US election result because it's pretty much bipartisan, but it shouldn't be viewed as deglobalization, as I mentioned. When you look at Asian countries, they are largely like three camps. One camp is countries are in the middle, as I said, can benefit from both sides of the geopolitical divide. Countries like Vietnam, for example, a lot of the international companies or even Chinese companies, because they want to escape from tariffs, they started to build and invest more in countries like Vietnam. The second camp would be countries that has irreplaceable natural wealth, like Indonesia, for example. The global transition would need a lot of copper, a lot of nickel, a lot of the key minerals that mainly the main world reserves are in emerging countries and a lot of Asian countries as well. And the third camp would be countries that have large enough domestic markets and then large enough opportunities for manufacturers and consumer brands, even in a world that probably you trade less than to the developed countries like China, like India. The domestic consumption market is still large and is growing very fast. So in all these three camps of EM countries or Asian countries, you do flag out beneficiaries potentially in more, I'd say, not even bipolar world, it's more of a multipolar world.
Yeah, so slightly more complex sort of picture when you look into the different countries there. Just changing sort of subject, I wanted to ask you about AI in particular. It's been another big, huge talking point this year. So I wanted to get your view just in terms of how you're sort of playing that theme, particularly, within Asia, and also maybe your observations about companies that you invest in, how they're starting to incorporate and use AI more in their day-to-day operations.
Yeah, so our current allocation within the fund has a quite strong conviction on semiconductors and semiconductor-related companies that are hardware manufacturers. They are world-leading companies, and they are almost monopoly or duopolies in their relative space, like TSMC, like Samsung Electronics and SK Hynix, etc. And also more niche suppliers on the dotted along the semiconductor supply chain. So they are the enablers of AI. And when you think about the applications of AI, we do think the AI hype up until now has been more focused on servers, GPUs, cloud computing, etc. The next wave may more be on getting your consumer devices AI ready, like getting your phones, your smartphones, your tablets, your laptops, etc., having start to have user-friendly like AI features. And that could potentially lead to the beginning of a new technology upgrade cycle. And when you think about Asian companies like, say, Samsung Electronics, it has the #2 foundry factory just next to TSMC. In a world that a lot of people want supply chain security, they like a #2, like a second supplier for their logic chips. It also has a leading high-end memory chip manufacturing section as well. And Samsung, also one of the largest smartphone producers, is also have a very large consumer device business. So it's going to a good setup to benefit from all these trends. In terms of the other applications in AI, apart from the hardware side, as I mentioned, a lot of the big platform companies that we invest in are also the leading investors and also the leading forces of driving AI usage in their, say, customer service, their data intelligence for a lot of algorithms that they run behind them. And here, the leading ones that we invest in are the Chinese platform companies, for example, continue to be very interesting. We did a lot of research in the more niche AI applications in, say, image recognizing or voice to text translations, etc. These are potentially ideas for the future, as the competitive landscapes remains relatively unclear, but it's foundation for future research. At the moment, our investment are mainly focused on one part is a hardware producers in Asia, and then the other part would be the AI applications, where the big platform companies who we think will lead the effort in this space from the region.
Great. And I wanted to ask you as well about how you manage risks on the fund across the portfolio. What's really key in terms of that?
I think the first and foremost thing is to have that pragmatic approach to growth and ensure that you have the names and the companies we own in the fund have a diversified or different routes to grow their business. So whether it's longer term compounding growth, steady growth, and the ability to reinvest, and then to grow for a longer term horizon, or fast, rapid growth, especially in the digital economy and digital business side, or sort of more cyclical growth, as I mentioned on the surprise bucket, is more like when you have an external shock or external change or turn around the business, etc., like that. These are not tactical bets. These are more cyclical, but will need to play in 3-5 years or even longer time for that to realize. I think that is the key thing, to make sure you have a diversified growth driver within the portfolio, so it's not being driven by only one particular theme, one particular country, or one particular industry. I think that's number one, the starting point. On top of that, we also have independent risk teams and looking at all the traditional risk measures, thinking about the correlations among the names that we own, and also whether our performance are coming from where we think the drivers should be. I think that is quite a key part of thinking whether we generated alpha from the alpha ideas that as we expected. So looking at the return decomposition is another way to think about the risk in the portfolio as well. We don't tend to measure ourselves by the tracking error to the index, because index is a quite poor starting point. There's a lot of non-growing state-owned enterprises in emerging market index, in Asian index as well. So being close to the index doesn't mean risk-free. So we do look at risk more pragmatically, and the key point of that is to make sure you have diversified growth drivers behind it, so it's not driven by one singular theme or one singular country or one singular company.
Great. And just a couple more questions. I wanted to ask you about ESG considerations on the fund, particularly, I suppose, in the governance area, and to get your views as well on transparency, how easy it is for you to get the data and information you need from the companies where you're invested, and is that improving, I suppose?
To start with, like, we are very long-term investors, like our investment horizon tend to be 5 years or even longer. And that means sustainability, like ESG and governance considerations, is an essential part, an integrated part, because you are not parking your money on the stock price for a few months, but you are actually own a part of the business for the long term. So that's the starting point. We don't look at perfect companies to start with. I don't think they really exist in emerging markets, in emerging Asia. What we more emphasize is the direction of travel and the potential progress, and that's where we as stock pickers can potentially make a difference. In terms of governance, it really varies from company to company and country to country. And most of these, like, listed companies would have the similar accounting rules, etc., as in the West. What we do emphasize a lot more is the direct access to management teams. So a lot of these companies are founder-led. Having a good relationship with the management teams is the best way to have that qualitative judge in terms of whether they are aligned with shareholders, minority shareholders, where they're thinking and understanding their strategy, and retest that quarter over quarter and year after year, and understanding the reasons why their vision has been implemented or vice versa. I think that's a very important part as business owners and understanding. We don't think relying on 100% on data is helpful, because a lot of these data are static and also backward looking as well. So back to the point, we're not looking for perfect company to start with. We're more emphasizing on the direction of travel. There are times we would work with other asset managers, sometimes as well with industry organizations, to enhance governance structure on listed companies, together with stock exchange, etc., on third parties. So that's another way, in addition to directly engage with the company's management team. So I guess it's a very nuanced approach, and I think our long-term goal is still to generate superior financial returns, and ESG considerations is part of the research that we did and the effort we make to try to help the companies to achieve their best potential, hence to return the best share price returns to our clients in the fund.
Great. Well, thank you so much for your time today. Thank you very much for the presentation and answering all those different questions there. It was really, really interesting to get your insight there. I'm just going to load my slides. We're just going to close the session. We're going to have a look at those learning objectives again. So you just bear with me. We'll just make sure they're coming up. Here we go. So yes, so learning objectives for this session. By the end, you should be able to understand the underappreciated macro resilience of Asia today, learned about the world-class Asian companies and the growth trajectory ahead of them, and explored the secular and cyclical opportunities in Asia. Again, thank you so much to Qian for joining me and taking our questions. If you do have extra questions after the session, please do get in touch with Baillie Gifford and they'll try and answer those. And I should say your CPD will also be delivered tomorrow. And just before we go, I want to give you a teaser of some other professional advisor events that will be coming up very soon. So for the remainder of 2024, next month, we have a series of regional working lunches in partnership with Orbis Investments. So if you live within easy reach of any of the following 4 destinations, why not come along? We can promise you 2 first-class presentations from Orbis's Roy Perrone and Ian Furtado of the Advisor Centre, 2 hours CPD and a delicious 3-course lunch. So on the 5th of November, we'll be at Stanley House in Blackburn. On the 6th, you'll find us at Longcliffe Golf Club near Loughborough. The following week, we'll be in Belfast on the 12th, and we finish our tour in Aberdeen on the 14th. If you'd care to visit any of these lunches, there are limited places remaining, and you can do so by visiting our website and clicking on the Events tab. We'll continue our busy November schedule with the ever-popular Retirement Planning Roadshow. That kicks off at Rudding Park in Harrogate on the 19th. On the 20th, we'll be in Warrington. And on the 21st, a new destination for us in Coventry. The following week, you'll find us in Bristol on the 27th and rounding off the roadshow in London on the 28th. You'll see an eclectic mix of presentations from Bourdieu, Just, Legal & General, LV, Octopus and Quilter Cheviot. And our keynote speaker for this series is Philip Martin, CEO of the advisor group Unique Financial Planning, and also obviously coming just a few weeks after what we think will be a pretty eventful budget next week. I'm sure there'll be some interesting comments from our speakers about any potential changes that we see there for retirement planning. And to round off the year, we have 2 digital working lunches for you. On the 4th of December, we'll be partnering with Baillie Gifford again, and we'll be joined by Rosie Rankin. She's going to be looking at the positive opportunities in 2025 and beyond. And finally, we'll be partnering with Schroders on the 11th of December, where Gillian Hepburn and Olivia Gelden-Hees will be joined by Unique Financial Planning's Philip Martin as they reveal and discuss the results of the annual Schroders Financial Advisor Survey. All in all, that's a total of 7 hours CPD over the next few weeks. If you wish to find out more information or sign up, you can do so by visiting professionaladvisor.com/events. And that's really all from us today. Thank you so much to Qian for joining us and taking our questions. Thank you for joining us as well. And we really hope to see you at another professional advisor event very, very soon.